Hello, everyone, and a warm welcome to our final webinar of 2023. This time, CIO Alexandra Morris will give you an update on the stock markets so far this year and her outlook for 2024. If you have any questions for us, please use the Q&A button at the top of your screen. And as always, we will provide with a recording after this event, and we'll send it to anyone who has signed up for it. Now, Alexandra, when we hosted your last webinar in March, Silicon Valley Bank had just folded, and there was quite a lot of uncertainty among investors. What are your reflections now, looking back as we approach the end of the year?
Well, first of all, I would just like to say hi to you all, and really good to see that someone has time for this before Christmas. And you're quite right, Ole Christian. At the start of the year, I was pretty optimistic, but then we had the overall performance of the stock markets actually are close to where I thought they would end. But the composition or how we got here is very different from what I expected. My view was firmly in the camp that with the sticky inflation and higher interest rates, it was time for value and time for stock picking. So that initially proved correct, but then we had Silicon Valley Bank and a few other blowups in the banking sector, although thankfully a full-on banking crisis was avoided.
And what happened following your last webinar took everyone by surprise, didn't it?
Yes, it certainly did. Unfortunately, for my bet on value over growth, I did not anticipate that AI mania would grip the markets with such a force for much of the year with the so-called Magnificent Seven rally. And it's also been another year when markets have been driven largely by the economy, with inflation data and interest rate decisions being the center of attention. However, stock picking has gained importance throughout the year, something I can talk more about when we discuss our fund's performance in more detail. So on the whole, it's been a very good year for stock markets, particularly considering the gloomy economic outlook at the start of 2023. Very different from what we had been used to since the great financial crisis with low interest rates and low inflation. And of course, the geopolitical instability and conflicts that unfortunately have been another feature this year.
And as always, the performance hasn't exactly come in a straight line, has it? And I guess this year shows how important it is to forget about ever trying to time the market, but rather stay in the market.
Absolutely. And more or less all of this year's performance has come in the first and the last quarter, or even more precisely, 3/4 has come in the last 7 weeks when the world index has increased by 15% in US dollar terms. And what's interesting is that most so-called risk assets have done very well, and some areas of the market that were really out of favor have had a great comeback. For example, the commercial real estate led by offices and retail malls has gained almost 30% in 6 weeks. And also the US regional banks that had such a big hit early in the year are more than 20% higher over these last few weeks.
And I suppose a lot of people have heard about the fear and greed index. And it seems it now has turned from extreme fear a month or so ago to greed now in December. Is this a valid thermometer for the stock market, you think?
Well, if you look at other indicators, they also point to a more positive market sentiment. We have both the one for institutional investors, like the latest November Bank of America Fund Manager Survey, which showed that institutional investors are now overweight equities for the first time since April 22. And also US retail investors bought 7 billion of stocks last week, which is the highest since March 2022.
And what do you think is behind the improving sentiment? And do you actually share the sense of optimism?
Well, the market rally since October has been led by the idea that inflation is largely under control without the economy entering a hard landing or recession. And also that central banks, particularly the US Federal Reserve, are done raising interest rates and now look likely to start cutting them next year. And this is truly a Goldilocks scenario.
And I guess one of the things the market despises is uncertainty. So does this mean there's more evidence to this Goldilocks scenario?
Well, the latest US data confirmed that headline inflation is indeed falling, but there are areas like shelter and services where it is taking longer for prices to fall, longer than many people expect. And wage inflation also remains relatively high. So in my view, it's still too early to say the fight has been won completely, and the path towards central banks' long-term inflation targets probably won't be smooth. The inflation numbers were followed by the very surprising Fed meeting 10 days ago when Jay Powell, the Fed chairman, signaled that the US interest rate could actually fall 3 times next year by a total of 75 basis points. This saw bond yields drop, the 2-year falling 25 basis points, equaling actually a full interest rate cut. And the dollar weakened and the stock market was then lifted to new highs. So the market certainly seems convinced now that we will be able to avoid a recession, which few people, myself included, predicted at the start of the year.
And what do you think this means for companies?
Well, these conditions should be positive for companies that have been quite wary of waning demand, higher input prices, higher debt servicing costs. So actually being able to avoid recession should help sustain demand, and the lower inflation and interest rates should help boost profits. And this is, of course, then good for stock prices too. Also, as the economic environment hopefully becomes more benign, I'd expect stocks to be judged on fundamentals and markets to be less occupied and driven by economic sentiment, which should be positive for bottom-up investors like Skagen. It's still too early to tell whether this will become a sustained rally, but there are definitely reasons for optimism as the economic picture becomes clearer. But as always, there are risks out there and it pays to be selective.
Indeed, it does. So where does this leave us as we enter the few weeks of 2023? How have stock markets performed this year?
Well, I think specifically for Norway, it's been an exceptional year because the Norwegian crown has weakened dramatically and has then had a dramatic effect on returns in Norway specifically. So the global benchmark is up 28% in Norwegian crowns versus 18% in euros or 20% in dollars. What's particularly interesting this year is that even more than usual, the headline returns mask big variations in performance beneath the surface. Most startling and much commented on has been the impact of the Magnificent Seven stocks, the Alphabet, Apple, Microsoft, Amazon, Meta, earlier Facebook, and Tesla and Nvidia, which combined have increased $6.5 trillion in market cap this year and making up 50% of the value added to the MSCI World Index this year. So to put this in context, the S&P 500 is up 21% this year. But if you take out these 7 companies, the index would actually be up only around 6%, much less impressive. In fact, the market cap weighted S&P 500 index has outperformed the equal weighted version by 14% this year. which is the highest differential since 1998, when the dot-com bubble was forming. So the effects of such a concentrated market with so few stocks doing the heavy lifting have been felt far and wide. The developed markets, where the US represents around 70% of the index, have outperformed emerging markets by around 15% this year. And EM, or emerging markets, have also been hurt by disappointing performance from China, which makes up nearly 30% of the index. So the Magnificent Seven have also helped growth to outperform value globally by over 20%. Although tellingly, value has outperformed in emerging markets, Japan and Europe.
Okay, so let's have a look at our equity funds. How have they performed, and what's your assessment of performance?
All 5 equity funds have delivered strong, solid, absolute returns in NOK and in euro. On a relative basis, 2 funds are ahead, Skagen Kontiki and Skagen M2, and 1 is in line, which is Skagen Focus, and 2 are lagging, which are Skagen Global and Skagen Vex year to date. And I think this is generally pleasing given the market headwinds that they've faced for much of the year, especially the Magnificent Seven, driving 50% of the global equity markets, impacting our globally exposed funds most, like Skagen Vex, Skagen Global, and Skagen Focus. And of course, the fact that large caps have outperformed small caps impacts Skagen Focus, which is a small mid-cap fund. Together with a solid outperformance in Skagen Kontiki and Skagen M2, I believe this really shows the benefit of good stock picking and diversification, being able to make money in individual companies even when the markets have been pretty weak or pretty skewed. And it is also important to remind everyone that 1 year is a short time frame when managing money for the long term. And we usually recommend a holding period of several years, and looking at a calendar year always paints a fairly arbitrary picture. And over 3 years, our funds have been delivering solid outperformance, which is pleasing. So I think it's fair to say to our clients that Skagen and our funds are continuing to deliver for them.
Let's look a bit ahead. What's your prediction going forward for the Magnificent Seven stocks? Do you expect their rally to continue into the next year?
I would like to say no to that. It's always hard to make forecasts with certainty, but I would say, simply based on mean reversion, that the performance of the Magnificent Seven is unsustainable. They now account for 17% of the global index, more than double of what they were a year before, leaving the other 2,900 companies to account for the rest. Will they take a higher share going forward, or will they at some point see a flattening or reduction? I think the risks from here definitely look to be more on the downside than the upside. We've also seen some insiders at Nvidia and Meta selling significant shares in November, which should be a sell signal. Normally is a sell signal, at least.
Right. Now, do we have any AI exposure in our funds?
Yes, we do. We do own 2 of the Magnificent Seven in our portfolios. Microsoft and Alphabet have been long-term holdings in Skagen Global. They are both at the forefront of AI technology, but unlike some of the others, they're not just one-trick pony, but they have very large proven business models that are not reliant on AI to grow. We also think there are other and cheaper ways to get AI exposure, for example, via the Korean company Samsung, which is one of the world's biggest producers of the semiconductors needed for AI to function, and ASML, which has a near monopoly on the photolithography machines that are used to produce computer chips. Both of these companies are driving AI behind the scenes and stand to win regardless of which big tech company grabs the headlines.
And what about your prediction for value to outperform? Do you still expect that to be the case?
I think generally speaking, we have entered a more normalized investment environment with interest rates remaining higher for longer and unlikely to return to the lows of zero or even negative rates we saw in the decade following the financial crisis. And I think we saw some of this happening in Europe and Japan, as I alluded to earlier, during 2023. So this means we should continue to see or see a return of the value premium, where value has outperformed growth for long periods. The longer-term structural tailwinds for value are also still in place, like the need to invest more in infrastructure, to upgrade existing infrastructure, and to invest in green transition or energy transition. And the companies that drive this, like industrials, materials, commodities, and those who provide the capital from financial services, tend to come from value sectors. And finally, on valuation, valuation tends to be the most reliable predictor of future stock market returns. And the PE differential between growth at 29.5 times earnings and value at 11.7 times earnings is still wider than the long-term average, which suggests that value will outperform again or continue in Europe and Japan, again, based on mean reversion and emerging markets, I must say.
Yeah. You said earlier that you think it will pay to be selective. Can you elaborate a bit on that, please? And where are you and the team currently seeing the best opportunities and also the biggest potential risks?
Well, before I answer that question, I have to say that as stock pickers, like we are in Skagen, with concentrated portfolios and fundamental research, we can always find value. And as long-term stock pickers, we do not jump around believing that we can magically time our exposure better than the market. So we always start with the companies and build our portfolios bottom up to secure a robust and diversified all-weather portfolio. So if you ask me where the opportunities are, I would remind everyone that we have almost 2,900 stocks that have done more or less nothing over the past 2 years. So there are huge opportunities for stock pickers like Skagen in general. But we can look at the opportunities from a bird's eye view, looking at regional valuations. We can see that prices are particularly favorable in Europe, especially in UK, where price earnings multiples are well below 20-year averages. Emerging markets also looks cheap, particularly relative to developed ones. And there are certain countries where valuations are very attractive, like Korea, where our funds hold several companies, which is trading quite far below its historic averages. And China is now at its cheapest for the last 5 years.
Now, Alexandra, you have been promoting small caps since the summer, and it all seemed to come loose about 6 weeks ago, with the US Russell 2000 small cap index went up 21% since the end of October. Is the rally over, or do you believe small caps still has some catching up to do?
Well, the short answer is no, the rally is not over. Looking at the historical valuations, the value of small caps has been really decade low on the cheap side. So this is really just a start, in my opinion. If you look at historic periods, the relative valuations of small and large caps and their returns over the subsequent 10-year period since 79. So you look at all the different gap between large caps and small caps since 1979, and then you look at the next year, 10-year outperformance. It shows that the gap that we have currently is really, really wide at present compared to history, and using that going forward should show a very large outperformance of small caps versus large caps over the next 10 years. it actually shows a 4 percentage points average outperformance per year for the next 10 years. So the discount is even wider for small cap value companies that we typically own in Skagen. Globally, they now trade at 12 times earnings, or 20% below historic averages, and which is a 35% discount to large caps. Prices that would normally signal that a deep and long recession is around the corner, when the economic picture for smaller companies is actually looking more positive than it has done for some time. So in fact, small caps have tended to outperform large caps once the Fed starts cutting rates, which now seems more and more likely than it did even 10 days ago. And one thing that I've mentioned earlier this summer, we have really started to see the start of merger mania, as large caps and strategic buyers may be hitting a soft spot in growth. They are looking to find well-run smaller companies at discount prices. We've seen this in our portfolios over the last couple of months, from September to November, where we've had 4 takeouts at healthy premiums that have benefited unit holders in both Skagen M2 and particularly Skagen Focus. So obviously, as stock pickers, we advocate being selective on a company level rather than investing blindly in regions or sectors. So prices are often cheap for very good reason. So you have to look closely to find those great opportunities for those who are prepared to do their homework and pick the right stocks.
And what about risks going forward? Is there anything that you're particularly worried about as we enter the new year?
Well, I think we can bundle risk into 3 areas. You have the concentration risk, the geopolitical risk, and the economic risk. 3 very different risk categories. Taking the first one, I don't think I'm alone in being concerned over the concentration risk that the mega cap technology stocks pose, especially to index investors, in particular in the US. The top 5 stocks currently make up 26% of the S&P 500, which is the highest since 1964. And at that time, in 64, the 5 stocks were AT&T, General Motors, Exxon, IBM, and Texaco. And the gap between the price-earnings ratio of the 10 largest stocks and the other 490 stocks is at its highest since 2000, excluding the pandemic, of course. But also for index investors more broadly, the size of the US market means that it now makes up 70% of developed markets and over 60% of the global index. This means that the Magnificent Seven are now bigger, have a higher market cap than Japan, UK, China, France, and almost Canada combined, which is a significant exposure risk. Now, the second category of risk is the rising geopolitical tensions, where we can now add the Middle East to the Russia-Ukraine situation. Although the market so far has done a relative good job of shrugging off these conflicts, even though the humanitarian costs are clearly horrific and terrible. China and US tensions are also never far from the surface, particularly now in an election year. And negative developments there would inevitably have a greater direct impact on global stock markets. But I am sure we will be focusing more on the US election as we close in during the next months. And of course, there are political shocks from other elections as well, in both the UK and India as well. Now, the last category of risk is an economic slowdown or recession, where inflation is still sticky, and although interest rates are lower, they will stay higher than the market anticipates. So any unexpected economic slowdown or recession would hamper earnings growth and potentially cause a rethink on monetary policy at a time when the margins for error are, quite honestly, quite small. But as stock pickers, we try to avoid getting too caught up in macro forecasting and leave that to other people. We prefer to focus on the things that we can control. Investing always involves risks. The key is taking the right risks and making sure we are rewarded for the ones we take. And we truly believe emphatically that the best hedge is to have diversified, concentrated portfolios.
Indeed. Now, finally, what are you most optimistic about, and how do you think 2024 will unfold?
Well, Ole Christian, there are many things to be optimistic about. Markets are at all-time high. Risk appetite is returning, which is particularly positive for areas of the market perceived as riskier, like emerging markets, small caps, and real estate. The macro environment is looking more certain and supportive for equities than it has done for some time. A soft landing seems to be within reach, with 2/3 of investors now seeing this as the base case scenario for the global economy in 2024. According to the most recent Bank of America survey, inflation also seems to be broadly under control and is expected to fall towards its long-term targets over the next couple of years. Interest rate cuts are on the horizon for 2024. This should also be supportive for emerging markets and small caps. A more normalized interest rate and inflationary environment is structurally more favorable for value in equities. Companies using tangible assets to generate profits in the here and now. So a more benign macro backdrop is supportive for stock pickers. Hopefully we can return to talking more about companies, about earnings and fundamentals, and less about economic conditions as the key factors driving stock market returns in 2024. But my final bit of advice to everyone out there is, of course, to stay invested. We've recently seen the powerful impact on returns a few good days or good weeks can have. And also the second thing is to stay diversified. 2023 has reminded us that the best returns can come from unexpected places, and who's to say 2024 won't bring more of the same?
Well, that remains to be seen. So 2024 is a really exciting year coming up quite soon. That's all we had for now, but do remember that if you have any questions for us, don't hesitate to get in touch or talk to your advisor. I'll say thank you very much indeed, Alexandra. I wish you all a Merry Christmas and thank you very much for watching.